good evening. This is Hound Dog Steve coming to you on the 7th of August, Monday evening. And I wanted to talk to you a little bit about housing and mortgages because, there's been a lot of concern lately in Toronto and in Vancouver of housing bubbles, what that means, and what a precipice we are approaching with mortgages, housing, and the people who have bought these houses, and some significant changes that are going to be happening within the housing industry by way of demand because of the baby boomer situation, the aging baby boomers. So right now, the average home price in Toronto is around about 800,000 to 1.25 million, depending on who you talk to. That is incredibly high when you look at the cost of borrowing. Now, the cost of borrowing is only about we're going to call it 2.5%, but my mortgage is about 2.36, I believe. And I think one of the big dangers is, the misleading information that homeowners are getting from the media. Okay, so I picked up a little story the other day, and this is in the Globe and Mail, and they were talking about home prices, okay, and how the change in interest rates affect the cost of mortgaging a home. And this came in a response to the announcement that the Bank of Canada was increasing its interest rate by 0.25%, and it was thought that the big banks were going to follow by raising their lending interest rates. But what I noticed with interest here, okay, let's get that in focus, I hope you can see it. So what it says there is it's based on the average price of a home in whatever centre you happen to live in, and also there is a 20% down payment. Now, as you'll see on the yellow line for Toronto, that number is $2,971. Okay, well, I have a mortgage at 2.36% on a $70,000 loan. Okay, so my repayments are $535 per month. So if you assume we'll take the average price to be $800,000 in Toronto, and if you take 20% off that leaves $600,000, and at 2.35%, that calculates out to $4,600 a month. And that's not including all of the extras that comes along with owning a house. So what we're looking at here is the Toronto Real Estate Board website, and they have the average single family historical home prices and trends for Toronto and Mississauga. And so your 2017 monthly statistics in June, the average house price in June was $793,915,000. Okay, and City News says average house price in Toronto continued to rise to $1.28 million in May. Okay, so that's your house price for you. Now, I looked up this cost of living in Toronto, and a single person monthly living costs, according to this, are $1,042.91, and that is without rent. Okay, so I went to some of their pricing, and when I looked at their estimator and I see what they were accounting for, they're a little out. And you've got to remember that in that money is no tobacco. Okay, going out $50 per month. You don't have a car, so there's no car and gasoline expenses. Public transport, they're allowing you a monthly bus pass for $145, and clothing and shoes are $33 a month. Now, pricing isn't bad. You know, a pair of jeans, Levi is $63. That's pretty well in the range, but still, that doesn't really leave. That's about $450 a year on clothing. So utilities, they have $113 per month. Okay, well, that wouldn't cover my hydro bill. Okay, internet of $29 a month or $30 a month. You're looking at basically $60 to $70 for high speed, and 1 minute of prepaid mobile tariff, no discounts or plans. Well, my monthly phone plan is about $80. So you can see that this, you could revise this upward, and I have done in my calculations. So this is incredibly deceiving to read these figures. So when you multiply that out, that's $48,000 a year in mortgage payments. Now on top of that, you have property taxes, you have home maintenance, you have your utilities, which again I think in the cost of living are way understated. So when you start factoring in all of these things, well, you're looking probably at close to $81,000 a year after tax income, and that's not running a car, remember. Okay, so you can probably add another 20 grand for a car on top of that. And if you have kids, oh my God, your food bill is really going to increase. So the big danger that we're in right now, and these figures, because these figures are so misleading. People sit down, they use these to work things out, and they don't really understand what it's going to be like to carry the burden of a home. And interesting enough, it does say here, forget housing as an investment. Well, that's right. You at those rates, you cannot possibly sell for more than these kind of prices. It may go up a little bit more, but because you see, all of this stuff is tied together, and this is where it gets a little bit more complex. Okay, because you have a situation right now where our interest rates at the central bank are very low, and most people think that our street banking system gets most of its money from deposits. That's its asset base that it bases, and it re-lends that money out. Well, no, that's not the case, because it doesn't carry enough money in deposits anymore, because people's savings are at historic lows because the cost of living is so high. So what do the banks do? They borrow that money from the government or from the central bank. Well, when the interest rate is at historic lows, which it is right now, the bank takes just millions and millions and millions of those dollars and turns it into debt. And how does it do that? It lends out mortgages at low rates, which fuel the increase in price in the cost of a home. But those mortgages are dependent on your income, and basically incomes have just stalled. The incomes are not going up at the rate that they need to do to allow people to borrow the amount of money to increase the cost of a home. So people right now are basically maxed out everywhere. I think the statistic for Canada is that people are spending, the average Canadian is spending 1.6 times their disposable income on debt servicing. So that means if you are earning $100 a month, you're spending 160, or if you have $100 a month disposable income, you're actually spending $160 on debt servicing. Now there's an equation that cannot possibly work out. Now what we don't understand about the banking system, or what most people don't understand about the banking system, is that the formula for banks, which is called the fractional reserve banking system, and this is taken right off the gold standard days when you had to hold back 10%, or you had to have 10% of your assets had to be held in gold, and you could lend 10 times the amount of gold that you had on deposit in your bank. Well, now they just use assets instead of gold, but the same principle applies. The bank gets $1 and it lends out 10. And when you do that, you have increased the currency base by a factor of 10. So because there was $1, now there are $10. And so every dollar has to be reduced by a small amount to compensate for that increase in currency out there on the street. And that's why people are always needing pay rises. This is why the government talks about and worries about inflation figures and this kind of stuff, because inflation directly affects your income in the way of affecting your spending power. So inflation right now is running about 6.1, 6.2% by my reckoning. The government's figures are absolutely bogus because they take out things like food and fuel because they say that those things are too volatile to be a mix into the equation, and so they just remove them. And can you imagine what my income statement would look like if I didn't have to account for food and fuel on my bill, on my cost of living every month? Of course, it would look like I'm doing really, really well. And so, these are not real figures. Okay, what they're using is things like, computers are coming down, electronic goods are coming down in price. But the real things, the real staple things that you need to buy every single day of the week are actually going up in price. So, the government is lying about inflation figures, which is misleading. The media are putting out stories which make it look like it's a lot easier to own a home than it actually is as far as figures are concerned. It's just not truthful figuring, playing it down. And so where we are right now is that there are an awful lot of people who are doing the tightrope act and hoping that nothing goes wrong. Well, home sales hit a record drop in July of 40%, and so the housing bubble in Toronto has officially burst. And I think that you are going to see a very rough period in the housing market. All of these new homeowners are going to get whacked with increasing property taxes, increasing utility costs, increasing energy costs in the form of hydro. I think that propane, gasoline and natural gas are somewhat going to stabilize, although they are overpriced. They're definitely being held high artificially because what they've done is cut back on the refining capabilities. And so it really doesn't matter now the cost of a barrel of crude oil. That's gone into a disconnect because it's really how much crude oil can you force through the refining pipeline. And the narrower the refining pipeline, the less crude oil can go through, and that is your bottleneck that the oil industry is using to keep the cost of gasoline and diesel up around $1 to $1.20 a litre in Canada, where it should really be around about 60 cents, 50 to 60 cents based on the cost of a barrel of crude oil. So, they shifted that focus. But these things, energy is not the usual kind of price increase, because energy affects everybody. Okay, so the person who is growing the food has to take an extra slice because their energy costs went up. The person who delivers that food to market has to take a slice. The supermarket has to take a slice because its energy costs and its employees' energy costs have gone up. Plus, you had to pay the energy increases in your life, as well as the increases to all of the things that you have to purchase. So this is not just a one-time hit for the consumer, this is a 4 times hit. So that's quite significant. I think we can all see that infrastructure is a massive, massive issue right now. Okay, just about everywhere you look, everywhere you turn, infrastructure has reached the end of its useful life. So for the next 25 or 30 years or so, you are going to see every bridge in the province under construction, every main street in the province under construction at some point in time in that 35-year span. All your water systems, your storm sewer systems are all reaching the past its age of usefulness. And that cost is going to be absolutely staggering. And so property taxes will be going up. There is absolutely no doubt about it. There is no other way that the municipality or the province or the feds have to pay for all of this stuff other than using your tax dollar. Okay, so expect your taxes to go upwards. So you have property tax increases, you have food increases, energy increases. Okay, hydro is going through the roof. They're expecting hydro rates to double in the next 5 years. That's why the Liberal government is bribing you right now to accept all of these changes, and you'll notice that the bribe is a temporary bribe. Okay, and that's not good because they haven't changed the structure. What they've done is they have changed your net result in your pocketbook, but this could be taken off at any time and business as usual. Well, if you're already at the edge of covering your mortgage, if your debt is taking 160% of your disposable income, and your food and other have inputs go up, well, you can see what's going to happen. It's going to get pretty desperate. Okay, and the other thing, there's a big shift in demographics taking place right here, and I see it all the time in Bobcaygeon because Bobcaygeon is a retirement town, and so we have aging baby boomers, and these aging baby boomers basically all bought houses that were about 3,200 square feet if you include the basement, most of which are finished now. And of course inflation has affected them the most because their interest on savings is absolutely negligible, and their cost of living has gone up in real terms year over year, far in excess of what their incomes have been doing. Their pensions have basically been keeping with inflation, and that of course is why inflation has been held down by jiggery-pokery, because the government knows that if inflation goes up, it's going to have to increase all of those pension amounts by the amount of inflation. And so these people now en masse, because the baby boomers, as you know, is this big bulging lump in the snake, as it were, as it digests a meal. All of the baby boomers now are feeling the same kind of pain, and so all of these houses are going to start going on the market at the same time, and the next generation coming up have a different idea about energy. They want energy efficient homes, they want modular homes, they want homes that are manageable and sustainable. Many of them are going south for extended periods of time, and so they don't need a huge home anymore. You can see the surge of news now about tiny homes and 3D printed homes and this kind of stuff, because that's the direction we're actually going in. So you're going to have a glut of houses on the market that are going to drive the price down. Because if there's not the demand for that style of housing, and you get a whole bunch of people trying to sell the same kind of house at the same time, well, this puts downward pressure on the market. Okay, so this is going to, in general, devalue any kind of larger home, and of course the smaller homes will go up in value, and so you'll be paying more for less. But that's the direction it's going to go. You're going to find a whole bunch of people stranded in houses that are too big to manage. They're going to put them on the market, and in desperation, as these homes become more and more of a boat anchor and inflation plays more and more of a role in their lives, they're going to drop the houses when they realize that anything is better than nothing. Another big issue is reverse mortgages. Seniors, listen up, especially widows. Is that sexist to say that? No, because we're talking about a particular age group, and many people in that age group, their husbands did all the financial stuff. Okay, well, they have been caught in the inflation loop as well, and so what they have been tempted to do is to get what they call a reverse mortgage, where you get an appraisal done on your home, and the bank will give you, say, 75% of the equity in your home, basically on a promise that the bank's going to get the house when you die, and you'll have enough left over to leave a little bit to your kids. That 25% equity that's or value that's left in the home, residual value, and I guess that's the buffer against the reality of what that house price will sell for. Okay, and it sounds great. This thing sounds great, and people go, "Oh my God, my house is worth $800,000, and I can get 75%. Hey, that's 600,000 grand. What could go wrong? What could go wrong?" Well, banks are not fools, and I will guarantee you in that contract, if you read that contract through or you give that contract to a lawyer, I will pretty much guarantee you that there is a clause in there that says if your equity goes below a certain level, you'll be required to pay the difference back to the bank. In other words, okay, you have a $800,000 house, you can get 75% equity out of that house in cash, it's $600,000. If, for example, the equity or the value of the home were to fall to $400,000, you can now only get $300,000 in cash. Well, say for example, you spent $400,000 of the $600,000 already. You're $100,000 short on the equity requirements for the home, and you'll be required to pay that back to the bank or mortgaging company that gave you the reverse mortgage. And don't worry, ma'am or sir, we can do that in easy monthly payments if you like. So in other words, you're going to find yourself at the age of 85 or 86 and you're being straddled with a mortgage when you couldn't keep up with the cost of living to begin with. So there you go. You'll have your $300,000 equity, $100,000 to the mortgager, and you got 200 grand left. And I hope that it only falls to 400,000 from 800,000. But you see the kind of thing that I mean. This game is all very good when house prices keep on rising, but when you have a flip side, there is a big price to pay. And I think that day of reckoning is here. I think this staggering drop-off in house sales is an indication that the housing market is in trouble, and you are going to see, as I say, hydro prices are going to go up. And one of the things I have noticed about utility costs and hydro costs, now I don't get natural gas, so I don't know if they've done the same thing, but what's happening up here is that most of your expense on the bill is actually the cost of getting the hydro or the water to your door, the delivery charges, the flat rate charges. So, on my hydro bill, even if I didn't pay the hydro, I would still be getting a bill for probably 75%. I think it is approximately about 25% of my hydro usage is actually the net cost of the bill at the end of the day. All the rest are delivery charges and debt retirement charges and this and that. And it's the same on my water and sewer bill. There are flat rate fixed charges that I pay just to have the water and sewer going past my door. So even if I use nothing, it wouldn't matter. I would still get a bill of about 75% of my water and sewer bill because of the flat rate charges on the bill. So this is the way it's being worked out. So it really doesn't matter. I mean, yeah, if you can save some hydro, that's nice, and you turn off your lights and you do your laundry at the correct time of day and so on and so forth. But because that portion of your bill is such a meager portion, the result is only negligible. The utilities and the property taxes and so on and so forth still get the lion's share on the bill, regardless. So I think this could be very troubling in the future. We've got sort of some opposing crosswinds coming into play here, and reaching a level where people just can't afford to buy into the game. Down payments. Can you imagine trying to save $200,000 as a down payment? Are you kidding me? It's hard enough as it is. Anyway, so I think that we should be very careful with the housing market. You should really review your situation. Frankly, if I was thinking of selling within the next year or so, I'd be selling now. Even if I had to rent somewhere in the meantime, I'd be selling now, because I don't think home prices, if they do go up, it's not going to be worth the increase you might have gotten, maybe an extra 100,000, to risk that chance that it's really on its last gasp. You've put massive restrictions on foreign home buyers, and you've kneecapped all of your domestic home buyers. The housing market has got nowhere to go now. And of course, with Toronto, Vancouver's already done this, putting a property tax surcharge on people with more than one home, where that second home sits empty and is not rented out. And again, the road to hell is paved with good intentions, of course, but and the reason for that was to try and push these houses out onto the market to make them available for new home buyers. But what it has done has it's squashed the investment level, and so again, that side of the market, the condo side of the market, is slowing down. So yeah, I think before we reach the year's end, I think this could be a black swan event in Canada, and I would be very, very, very wary if you are a young person about to get into this market. If you are a flipper, I think I would be hanging on right now, and I would just wait until we get into 2018, because I think it's either going to keel over or it's going to stabilize. Maybe prices will drop a little bit and it'll stabilize and continue on, but you will know by 2018. So you won't have to wait long, but I would be thinking, I'd be just hanging on and waiting to see what happens. Anyway, don't get caught in a trap. Be very wary and do your homework. Talk to somebody who's already bought a home for around about the price that you're considering, and ask them what it's like, especially if you're a first-time home buyer. Okay, try and find out what it's really going to be like, because it's a bit of a shock. It's not like renting. It's not like renting. There are all kinds of things that you never consider. Anyway, I hope that's been of some help, and consider very much what you read in the paper and some of the figures that you're offered. They're not always reliable. I'm going to put a link below to John Williams' website. It's called shadowstats.com, and he calculates inflation, unemployment rates, and that kind of stuff based on the way we used to in the 1960s, so that you can at least compare apples to apples. So for example, just going to continue on in a different vein here for a second, but they're talking about $15 minimum wage. I mean, the truth is, had minimum wage kept up with inflation, it would be $32 an hour. And it's no coincidence that government workers and factory workers and people who have leverage over their employer, that they are earning around about, fancy that, $32 an hour. Okay, so minimum wage at $15 an hour nowhere near keeps up with the cost of living. Now, of course, I know we have to realize that minimum wage is an entry-level wage. Okay, you're not supposed to come in, you stay at $15. Unfortunately, so much of the employment today is part-time, because employers don't want to pay benefits, they don't want to have a unionized worker, so they bring them in as part-time temporary, so they can be let go easily. And so there is no security for the employee, and minimum wage now is becoming the norm. And I realize, that this is the rock meeting the hard place. I realize that this is a hardship on employers to have to increase. Although, I mean, what's going to happen in reality is that increase from, $11 an hour to $15 an hour is just going to come out of the consumer's pocket, because it'll be just written down as a manufacturing expense, whatever it is, or a service expense, and it'll be reflected in the price of the goods. So one way or another, you are going to pay for that increase. But I feel sorry for the people making $15 an hour part-time, because that's only, that's only, say you're only working 20 hours a week, that's only $300 a week, $1,200 a month. Most rent in this town, you're looking between $800 and $1,200 a month, plus utilities on top of that. So say, $1,000 to $1,200 a month. Well, two people working part-time might be able to afford the rent and a few of the basics. So we've reached this in many areas. The housing is the same thing. We've reached this kind of pinnacle, where it has to go either one way or the other. it is so obvious that if your income does not keep up with your expenses on your basic necessities, then you're not buying things outside of that. So who's buying a car? Who's buying a vacation? Who's buying a new dining room set or a new living room set or a new computer? You're going to make these things last, and a new car. So one way or another, these things have to resolve themselves. The government, statisticians, economists have all been lying about these figures for years and years and years and years and years now. And of course, because there's been enough money in the money pool, there's been enough to go around. But now inflation has just caught up to the point where those who were living a difficult existence, it's now become excruciating. The middle class have become the upper working class. So there you go, and all these people are spending less and less and less money directly into the economy. So something has to give somewhere. Anyway, I hope that explanation has been of help, and because there are a lot of things going on and a lot of misleading information, and so you really need to start researching before you make any serious moves. Okay, thanks a lot for listening. I hope you enjoyed that. Please like, subscribe, and share, and you have yourself a great week coming up.